Welcome to your personalized deep dive. I know you're always interested in new investment opportunities, and it's a new year, so what better time to explore some fresh options?
Absolutely.
Today, we're diving into commercial real estate, specifically in Texas. Using this Eureka Business Group newsletter from January 11th, 2025, what caught my eye is that they're not just talking market trends, they're showcasing pre-vetted properties, which is a huge time saver for anyone serious about investing.
Yeah, pre-vetting is definitely a valuable service, helps streamline the whole process, allows you to focus on properties that, have already been assessed for their potential.
Right. And get this, there's a surprising amount of variety. We're not just talking about those massive multi-million-dollar deals. There are actually quite a few opportunities under $1 million. I'm excited to dig into this with you.
Yeah, the variety in price points is
Yeah,
a good indicator of a healthy market, one that caters to a range of investors.
definitely. The newsletter mentions that the market slowed down a bit at the end of 2024, but things are picking up now. Have you noticed any shifts in activity lately?
The beginning of the year often sees a surge in real estate activity. People are energized,
Yeah.
setting new financial goals, and looking for opportunities. Real estate is cyclical, so those slower periods are often followed by a rebound.
That makes sense. Let's jump right into some of those bite-sized investments. Under $1 million. This 8,803 square foot space is interesting. It could be used for office, retail, or even medical. And the owner is vacating, so you could potentially reposition it and lease it at the current market rate. Then there's this 2,727 square foot vet clinic, which also seems promising. Both are in good locations, according to the newsletter. What are the advantages, and maybe disadvantages, of starting with smaller investments like these?
Think of these smaller investments as potential stepping stones. They allow you to diversify your portfolio without committing a huge amount of capital up front. It's a way to get your feet wet, learn the ropes, and gain experience in commercial real estate, of course. The potential returns might be more modest compared to larger investments, but they can still generate steady cash flow and appreciation over time. It really depends on your individual investment goals and risk tolerance.
That's a great point. I also noticed that many listings, even the bigger ones, are STNLs, single tenant net leases. Can you remind us what those are and why they might be appealing to certain investors?
Sure. With an STNL, you have one tenant, often locked into a long-term lease. And here's the key. They're responsible for most of the operating expenses, like property taxes, insurance, and even a maintenance. This structure offers investors a more predictable income stream and requires less hands-on management.
Ah, so less hassle and a more predictable income stream. I see the appeal. Several listings highlight corporate guarantees as a benefit. Can you explain how those work and why they matter?
A corporate guarantee is like an insurance policy for your investment. Let's say your tenant is a big national chain, like, say, Home Depot. If that specific store were to struggle and default on their lease, the parent company, Home Depot Corporate, would be obligated to fulfill the terms of the lease. This significantly reduces the risk for you as the investor.
So it's like having a safety net for those long-term leases. That makes me feel a lot better. Location is consistently emphasized in this newsletter. Why is location so crucial in commercial real estate, particularly for someone like you? And what should our listener consider about location when looking at these properties?
It's simple. A well-located property is more likely to attract customers, tenants, or businesses. Think about visibility, accessibility, foot traffic. These all contribute to a property's value and its potential for generating income. And yes, location plays a massive role in my own investment decisions. I always analyze the demographics, the surrounding businesses, the traffic patterns, and the overall growth potential of the area. For you, as you look through these listings, consider the types of businesses that thrive in certain areas and how that aligns with the property type. Would a childcare center be a good fit in an area with lots of young families? Would a high-end retail store do well in a more affluent neighborhood? Those are the types of questions to ask yourself.
That's great advice. You've got me thinking like an investor already. And speaking of potential, we keep seeing value add opportunities mentioned. Can you break down what value add means in this context?
Value add is all about finding properties with untapped potential. It might be a property that's slightly run down, has a high vacancy rate, or simply needs some upgrades to attract better tenants. The idea is to make strategic improvements that boost the property's value and generate higher returns.
So it's like finding a diamond in the rough and polishing it up. I like that. The Eureka Business Group newsletter highlights a couple of listings with this value add potential. One is an 8,251 square foot retail center that's only about 70% occupied and has had some recent renovations. The other is a 56-unit multifamily property. What kind of improvements could be made to these types of properties to increase their value?
For the retail center, it's about filling those empty spaces with the right tenants. Maybe modernizing the facade to make it more visually appealing, or adding amenities that attract customers. Think outdoor seating, a community space, even something as simple as improved landscaping. With the multifamily property, you might consider upgrading the units with modern appliances and finishes, improving common areas like the gym or laundry room, or adding amenities like a dog park or a community garden. These types of improvements can justify higher rents and attract a more desirable tenant base.
That's really interesting. It's like you're taking something that's good and making it even better. I love that.
Yeah.
Now, here's a specific niche that caught my eye: childcare centers. There are several listings for those in the newsletter. What are your thoughts on investing in childcare centers, especially in a state like Texas?
Childcare centers can be a compelling niche, especially in areas experiencing a rapid population growth and a surge in young families, which definitely describes Texas.
Yeah, you can't exactly put childcare on hold just because the economy is shaky. It seems like a pretty recession-resistant industry.
You've hit on one of the key advantages. People need childcare regardless of economic conditions. However, childcare centers also face more regulations and licensing requirements, which can add complexity for investors. You'll need to factor those costs and considerations into your due diligence.
So it's a balancing act, weighing the potential rewards against the complexities. Before we dive into specific listings, can you give us a broader perspective on the Texas real estate market? What makes it so attractive to investors right now?
Texas has been on investors' radar for several reasons. It boasts a business-friendly environment, a lower cost of living compared to some other states, and a vibrant job market. These factors are driving significant population growth, which in turn creates a strong demand for both residential and commercial real estate. Texas also has no state income tax, which can be a significant draw for both individuals and businesses. It's a dynamic market with a lot of potential, but careful research and due diligence are key to making informed investment decisions.
Texas seems like the place to be right now. This newsletter from Eureka Business Group is really opening my eyes to the possibilities. We've covered a lot of ground already, from those smaller investments to understanding concepts like STNLs and value-add opportunities. Plus, we've gotten a glimpse of what makes the Texas real estate market so attractive. We've laid some great groundwork. But let's get down to brass tacks and look at some of the specific listings in this Eureka Business Group newsletter. This 2,240 square foot retail space caught my attention. It's an STNL with a corporate guarantee and over 11 years left on the lease. That's a lot of stability. I'm guessing that appeals to a lot of investors.
Absolutely. Long-term leases like this, especially with corporate backing, offer a sense of security and predictable income. Investors love that kind of stability, especially in a market that can be unpredictable.
Right. Speaking of stability, there's another retail STNL in the Austin area that looks promising. It's 6,864 square feet, also with a corporate guarantee, and over 7 years remaining on the lease. We all know Austin is a hot market. What are your thoughts on its long-term prospects?
Austin's growth has been phenomenal, and it's showing no signs of slowing down. It's become a major tech hub, attracting businesses and young professionals, which fuels demand for commercial real estate. I think it's a property. With its corporate guarantee in prime location, has the potential to be a solid investment.
Yeah. Let's shift gears and look at a few listings in the $2 to $5 million range. Remember that 8,251 square foot retail center we talked about earlier, the one with value add potential? It's about 70% occupied and has already had some renovations. If you were the investor, what kind of tenants would you target to fill those vacant spaces?
That's where the real creativity comes in. It's about understanding the demographics and the needs of the community, ideally. You'd want to mix of tenants that complement each other and draw a diverse customer base, maybe a local coffee shop, a boutique fitness studio, a healthy, fast casual restaurant, something that creates a vibrant hub for the neighborhood.
Creating a destination, not just a shopping center. I like that approach. There's also a 17,845 square foot vet clinic STNL in this price range. It boasts a great location, a long history of tenancy, and the newsletter describes it as a unique tenant with no competition. That seems like a pretty strong selling point.
Yeah, a unique tenant with no direct competition can be a huge advantage. It reduces the risk of losing that tenant to a competitor down the street.
Yeah,
And let's face it, people love their pets, so vet clinics are always in demand. This one seems like it has the potential to be a very stable and profitable investment.
definitely. Now, there's another retail STNL in Plano that caught my eye. It's 12,900 square feet with zero landlord responsibilities and an 8% cap rate. That 8% jumped out at me. Can you remind us what a cap rate is and why that number is so significant?
A cap rate is a way to measure the potential return on your investment. Essentially, it tells you what percentage of your initial investment you can expect to earn back each year from the property's net operating income. An 8% cap rate is generally considered quite favorable in most markets, suggesting a good balance between risk and potential return.
So a higher cap rate generally signals a better potential return. But it's important to consider the specific market and property when making those comparisons.
Exactly. It's not the only factor to consider, but it's a key metric that investors use to evaluate the potential profitability of a property.
Right. This newsletter also features a new construction retail STNL, about 4,000 square feet with a corporate guarantee, and a 7.25% cap rate. What are some of the benefits of investing in new construction?
New construction often means fewer immediate maintenance costs, modern amenities that attract tenants, and the potential for higher rental rates. Plus, you have the opportunity to select tenants that fit your long-term vision for the property.
So it's like starting with a blank canvas and creating something special.
Exactly. And that can be very appealing to certain investors.
Yeah, I can see that. Let's move up to the $5 to $10 million range. We talked about a 6,600 square foot retail center, described as a trophy asset in a top affluent area of Plano. It's got value-add potential through leasing. Can you break down what makes a property a trophy asset?
A trophy asset is more than just a high price tag. It's typically a prime property in a highly desirable location, known for its architectural significance, strong tenant occupancy, and consistent performance. It's often the kind of property that investors hold onto for the long haul, appreciating its value and prestige over time.
Like owning a piece of history. I understand why it's called a trophy asset. We also have a couple of childcare center STNLs in this price range. One is a 2024 construction with a 7.25% cap rate and a 15-year lease with minimal landlord responsibilities. The other is in Frisco, also a 20-year sale leaseback with a 2022 construction. Both seem like solid opportunities, especially in a state like Texas with so many young families.
They do. Long leases, minimal landlord responsibilities, and a steady demand for childcare services make these types of properties attractive to investors seeking passive income and long-term stability.
For sure. I'm starting to see a pattern here. Long leases, corporate guarantees, strong locations. These seem to be the hallmarks of a good investment. Let's jump up to those properties over 10 million. There's a 9,000 square foot retail STNL in a dense retail area with highway frontage and a 20-year corporate guarantee. Highway frontage is a big deal, right?
Absolutely. Highway frontage equals visibility and accessibility. It's prime real estate for retailers who want to attract a large customer base. A 20-year corporate guarantee on top of that is pretty much the icing on the cake.
Yeah. Wow. And last but not least, we have a 14,577 square foot industrial STNL in Allen, built in 2020. With a strong tenant. We've talked a lot about retail, but what's the appeal of industrial properties these days?
Industrial real estate has been booming, fueled by the growth of e-commerce and the increasing demand for warehousing and distribution centers. These properties tend to have longer leases and lower operating costs compared to retail, making them attractive to investors seeking stable long-term returns.
Wow. This newsletter is really a treasure trove of information. I'm feeling a lot more confident about navigating the world of commercial real estate in Texas. What stands out to you from all these listings? What are some key takeaways for our listener?
What's remarkable is the sheer variety of opportunities. Within a single market, we've seen everything, from smaller entry-level investments to large-scale trophy assets, from retail and office spaces to industrial properties and childcare centers. It demonstrates that there's truly something for every type of investor in Texas, regardless of your budget, risk tolerance, or investment strategy.
I love the idea that you can tailor your investments to your individual goals. You don't have to be a real estate mogul to get started. This deep dive has been incredibly insightful. I've learned so much, and I'm sure our listener has too. It feels like we've done a real deep dive into this Eureka Business Group newsletter. I'm starting to think about what kind of commercial real estate investor I would be.
Yeah, that's the exciting part, isn't it? We've seen the range, but now it comes down to your individual goals and preferences. Are you looking for passive income, with long-term leases and corporate guarantees? Or are you more drawn to those value-add opportunities, where you can roll up your sleeves and potentially create significant value?
Yeah, that's the question, isn't it? And there's no right or wrong answer. It's all about finding the approach that aligns with your risk tolerance, your investment timeline,
Yeah.
and your overall financial goals.
Exactly. And remember, knowledge is power. The more you understand the market, the different property types, and the key factors to consider, the better equipped you'll be to make informed decisions.
Right. This deep dive has definitely armed me with a lot more knowledge about the Texas commercial real estate market. But I'm curious, as we wrap up, what's the one key takeaway you hope our listener walks away with?
If I could leave you with one thought, it would be this. If you were to invest in commercial real estate in Texas, what would be your top priority? Would it be location, the type of property, the potential for growth, or perhaps minimizing risk?
That's a great question to ponder. There's no single right answer, but taking the time to define your priorities will make the entire process much clearer and more focused.
Absolutely. It's about creating an investment strategy
Yeah.
that's tailored to you, your unique circumstances.
Well, I think we've covered a lot of ground today. We explored different property types, investment strategies, and the overall appeal of the Texas real estate market. We even took a close look at some specific listings from the Eureka Business Group newsletter, which really brought it all to life.
Yeah, it's been a fascinating exploration. And remember, this is just the beginning. There's always more to learn and discover in the world of real estate.
We've loved guiding you through this deep dive, and as always, feel free to reach out with any questions or insights you might have. Happy investing. And until next time, keep exploring those possibilities.